July was a big month for news and for the stock market. In this video, we're going to go over the three major indices and how they did in July. We're going to go over the unemployment rate, the 30-year mortgage rate, what the Fed did in July, and what it means about the future for this economy as the Fed continues to try to fight inflation. Guys, I'm active on Twitter. I talk a lot there. I've only had it for 14 or 15 months. I already have 1,500 tweets almost. So follow me there if you want to engage with me. I engage daily. I talk about investing. I talk about the economy. I answer questions. I'm very active with it. So let's get with it. So first off, the worst performer of July was the S&P 500. It only went up 3.11%. I say only facetiously. That's an annualized rate of probably pretty close to 40%. The NASDAQ was up 4.05%, so handily beating the S&P, and the Dow beat everyone. I think even today the Dow is up, even though the S&P and the NASDAQ is down to start August. The Dow finished up 4.3%. Everybody I see on Twitter is saying, oh, let's stop calling this a bear market bounce. This is a new bull market. I want everybody to remember, from 1966 to 1982, the stock market went nowhere. But in that time, we hit new highs several times in the stock market. We have valuations that are still very high. If you're part of our community, every morning I announce the stock market to GDP ratio, as well as now the 10-year cyclically adjusted PE ratio. Currently, we're 86% overvalued on basically both of these metrics. The 10-year cyclically adjusted PE ratio, what that does, it takes the last 10 years of profit in the S&P, brings it to today with inflation, and divides the market cap by that, and we're at 32 as of this morning. 32, the historical average is 17.04. The stock market GDP ratio, what I did was I created my own ratio, taking the S&P and S&P equivalents, going back to 1929, and looking at them as relative to stock market, to the entire U.S. economy. The entire U.S. economy. So we're at 1.73 or so ratio. Historical average is about 0.93. We are 82 or 83% overvalued there. So this market's still overvalued, and I still see the hype. I still see how high certain AI and hype stocks have gone this year. So I still sit there and urge caution. Are there still good companies to buy at great prices? I'm sure there are. I own 12 companies on my own. I'm adding to them every single week. Certain ones that are still hitting my parameters. I don't just buy just to buy. On this channel, as you know, we're trying to teach a process. We're not trying to predict what's going to happen with stocks, even though people think my stock market GDP ratio is all about predicting. It is not. It's just saying, what does it look like in terms of the future? And right now, the future in the stock market doesn't look great for the next 10 or 12 years based on history. I'm still buying stocks. Now, do I still have some short positions? Absolutely. Now, mortgage rates on everybody's mind. Back in December of 2021, mortgage rates hit a low, according to Freddie Mac, of 2.61%. It finished July, according to Freddie Mac, at 6.81%, which is still off the high of 7.08. Now, guys, it depends where you look. Like if you look at bankrate.com, it's a totally different interest rate, but this is going according to Freddie Mac. We're at 6.81% on the average 30-year treasury. Guys, if you like this video so far, I need you to do me a favor, subscribe to the channel, because this is the channel you'll go to when things feel the worst. We'll be the ones to bring you back to a rationality to say, listen, every investment's the present value of all future cash flow, and the stock market isn't going to zero. We're here to teach a process so you can apply that process to the things that make sense to you. It's not about mimicking what we do. It's about taking the process. Every value investor has a very similar process. They apply it in different ways to different areas. That's what's key here. All right, another thing, unemployment rate, 3.6%. This, to me, is the thing the Fed is most concerned about. Low unemployment rate is inflationary. And you might wonder, why is it inflationary? Well, the lower the unemployment rate, the more people are working. The more people are working, the less option employers have for a variety of employees. So they have to pay more money to get better quality employees. Now, what I'm going to say next might sound cruel, but it's not meant to sound cruel. At 3.6% unemployment rate, it is hard to find great quality workers in that low. That means everybody's being employed essentially, except for maybe some people who lose jobs temporarily. It's hard to find really good, high quality employees who have to pay more and more money. I look at us as a business. We have several businesses upstairs. I look at the prices we paid, the wages we paid 2 or 3 years ago, a lot higher today. I think those, like now I look at it going like, oh, that's a steal at $15 or $16 an hour for a groundskeeper. And before it was $12 an hour. That's some real growth. Now, am I upset by that? No, absolutely not. I just pass it on to my consumers. And that's what I want to remind people. That higher wages don't mean that the business is just swallowed. They just pass it on to consumers. Absolutely. That's what's going to happen. And that's why it's inflationary. Because of the goods and services that you're buying have higher costs because of the wages being paid. That is inflation in the entire nation's eyes. That's how you feel it in your pocketbook. If that hamburger at McDonald's costs 20 cents more to make, guess how much more McDonald's is going to charge you for that hamburger? At least 20 cents more. You are going to feel it. They're not just going to swallow it. That doesn't happen in the world of business. They still have investors and they still have their own lives to pay for. I always remember that with our previous host, he would always say, like, I just thought more wages meant people just made more money. Well, yeah, but more money meant more costs. More costs meant less at the end of the day, still the same amount of money or some relative amount back in your pocket. So I really want everybody to understand that here. Speaking of wages, in the last 1 year, total comp was up about 4.5%. Total comp was up about 4.5%. And the PCE, which is the inflation index that the Fed really looks at, it excludes food and energy, was up 4.1%, which is the lowest it's been up in the year since September of 2021. Why did they exclude food and energy? Well, those are very volatile costs. They can change literally daily. They do change daily. As opposed to wages, it takes a little bit longer for wages to change there. It takes a lot longer for normal goods, like even toys you buy or clothes you buy, to see through on the wage increases and the cost increases. But energy, you guys see it at the gas station. Every day those prices are changing. Food, very quickly. Because a lot of food it's made. I mean, if we have houses in Mexico. A friend of mine there owns a banana plantation, and literally the time it takes from cutting off the tree to our grocery store is days, a couple days, and it's there. That's what the amazing part is. So you're going to see those inflationary numbers come a lot faster in food and energy, and that's why the Federal Reserve doesn't look at that. So the Fed raised rates this month, another 0.25% to 5.25 to 5.5 range of where they want things to be. Keep in mind, they started raising rates back in March of 2022. And since then, now the market's basically even. So the justification for low valuations before was, hey, rates are so low. I can get 0% in the stock market in my checking account, but I can go to the stock market and get 1.5 or 2% dividend. I might as well invest there. Okay. But now we have rates that went from 0% to 5.5%, and people are saying, nope, we're good. This is all great. Guys, I don't see how it happens long-term, how this sustains long-term. This AI boom, all these things that are happening are just confusing to me. Now, in the short run, anything can happen. We've seen, annualized returns of 50% in the NASDAQ in July. That's pretty high numbers. Is that sustainable? I don't know. I doubt it. The VIX, which is the volatility index, has hit really low levels, 13 to 14, been pretty consistent there for the last month. That's pretty low. Now, what does that mean? I don't know what's going to happen, but eventually something has to happen. I don't believe we're in a new bull market. Could I be wrong? Sure, absolutely. Absolutely. We've seen nothing but an increase since March of 2009, essentially, except for last year, and even last year is gone now. And COVID, that was gone in a month. We haven't seen a real long-term bear market. And for us to get back to normal valuations, we have to get a trudging out. Think about it. If it's this easy to make money in investing, who can really make outsized returns? In order to make good money in investing, apart from matching the market with a long-term ETF, which we do recommend, you got to think differently. You can't think differently if everybody thinks like you. Or you can't think different. If you think like everybody else, you're not thinking differently. So when I see all these hype stocks and everybody's saying, oh, cash flow doesn't matter. Okay, cash flow doesn't matter. But as you know from watching our channel, every investment is the present value of all future cash flow. And all these things we talked about can affect things long term. Think about it this way. All these companies had all this debt, and they added debt onto their companies in the last 10 years because rates were so low. And I don't blame them. Refi your debt. Grow with that debt. But at some point, the average corporate debt is about 5 years, I believe. The 5-year rate when they start to refinance is going to really increase. If a company has $50 billion in debt, and in 5 years, their rates go up 3%, that costs them $1.5 billion extra per year. That is not something to scoff at. That will cost real money down the road. Again, doesn't mean you avoid them. It just means, hey, be aware of this. Factor it in when you're analyzing businesses. Look at real estate. We weren't buying real estate in the last few years because people were paying nosebleed prices. Now we're being more aggressive. Why? Because we're hearing from brokers that the raising of interest rates is causing a pull down in demand. We just made an offer on a really big portfolio in Ohio, and the price actually, the guidance price actually lowered from the time we started looking at the property. Why? Because interest rates went up. And I always tell people, if you're a good investor, if you have a good process, you'll figure out a way to make money in any market. And that's what's key. I learned how to make money off options during this bull market that I was avoiding these hype stocks. I figured out a way to make money on options. I figured out a way to day trade. I figured out a way to long-term and swing trade. And that's what we're teaching on this channel, a way of thinking. So again, guys, if you like this, subscribe to the channel. You will really love it. Watch our videos. We're very active. We do videos every single day. It's really, truly important for you to change your financial future by getting somebody's perspective, because I guarantee you that when we have a big, bad bear market, whatever that entails, we will be the channel saying, it's okay. Just like in 2021, February of 2021, when we were sitting there criticizing every hypester out there and the stocks they picked, and some of those stocks have actually gone bankrupt since. We're there. We're the guys to go to for rationality. Now, the thing that stinks is when things are going up irrationally, we tend to look stupid. I'm fine with that, because when things go down irrationally, I'd rather look stupid saying, buy this company now. And that'll happen. Buy investments now. So guys, I appreciate it. Again, subscribe to the channel. If you could, share this video with somebody who might find value in it. Thank you very much for your time.